Hey, it's Jason Coleman, mortgage broker with Price Mortgage. And today we're just going to go over some of my opinions and we're going to review some of there's my phone going off, some of the articles that I'm reading and some of the videos that I'm watching on Wealthion, on Reventure Consulting, one rental at a time. There's quite a few great consistent video producers out there that I think are talking a lot of sense. So first of all, I want to visit this article right here that says mortgage applications are at a 22-year low. 22-year low. So here we go. We're talking why are applications at a 22-year low? Well, I think we have demand destruction, which is what the feds are trying to achieve to slow down inflation. So we have energy costs that are going through the roof, and I think that they will continue to go up, right? And so if we're talking housing here, I'd like to visit this Wealthion video that just came out after I put out my video yesterday. I got a little bit of slack about saying, hey, wait for 5 or 6 months. If you're a renter right now, wait for 5 or 6 months and see where the market takes us with this inventory. And I'm going to put a clip up right here. And this is Nick with Wealthion. I love Wealthion. If you follow the channel, I think they have great insight with a lot of great economic people in the game. So let's check out what he has to say.
And then finally, renters. If you're a renter right now, I think a lot of renters feel way less FOMO to buy. But my recommendation is wait it out. You are under no pressure anymore to buy. I think the rent increases are going to start going down over the next year across America. And you're going to need to see how this higher inventory situation plays out in the housing market before pulling the trigger, because it's not only about lower prices, it's also about finding the home that you like and that best suits you, right? And so that's the beauty of more inventory on the market, is not only you're likely to get a lower price, you're going to have more of an option to find the home that you really like and are going to want to stay in for a long time. And we're just getting started with these inventory increases. So inventory is still historically low. Let's wait 6 months and see what the situation is in 6 months before deciding to buy if we're a renter.
Okay, so that was interesting. That's kind of what I said yesterday, right? He's kind of saying the same thing. Now, he's been saying housing crash for probably 2 years. And I think I might have mentioned it probably a year and a half, 2 years ago. So now let's visit the Airbnb that Cheryl and I bought in March of 2021. This was 2943 South Presidio in the Pines neighborhood. We listed for $635. We got it bid up in March to $701. And now we see a couple other similar properties. In fact, 8 properties in this neighborhood, and they're ranging from $850 down to $650 right now. Now, the $650,000 home here, that has had a $35,000 cut. It's been on the market for a couple weeks. You have another that just had a $5,000 cut. It was at $665 and now it's at $660. It's been on the market for 56 days as of today. And so we have 8 choices and none of them are moving. I'm watching it closely. Now, I also want to visit Munns Park. We really wanted to buy in Munns Park, and we saw a cute little $300,000 A-frame. And by the time we were driving up there, Aaron Saracola, our realtor friend, he made a phone call and they said, hey, if you don't have $400 cash, don't even bother putting in, and this place was, septic tank. It had no upgrades or anything ever. And it was the 1970s, and it looked like the 1970s, and that's where it went off at in 2021. And so and there was only maybe 1 or 2 for sale in Munns Park, and in Flagstaff there was only 3 homes we were able to actually look at, and that's why we decided on the townhome. So I saw interest rates are going up, and what's that going to do to appreciation? Because frankly, we just weren't cash flowing even on a 2.3% 30-year fixed. 2.3% 30-year fixed. We put down 10% as a second home, and after 12 months, we weren't cash flowing. The only cash flow I saw was the appreciation on the home. It had gone way up, and I said, before interest rates go up, I'm going to unload. And I think that's a lot of the mentality that's coming to the market right now with real estate. So now in Munds Park, we have 29 homes, and I'm seeing all kinds of price cuts. Now, were they overpriced? Well, I think everything was overpriced in the past, 2 years. So, and that had to do with inventory. It had to do with super low rates, and the super low rates made it affordable. But now that rates are up, these entry-level homes, even the second homes, the pricing with second homes has gone through the roof. It's ridiculous on second homes. And if you're trying to be an investor and cash flow with rents, well, you're at 6%. And even with 20% down, it doesn't make any sense. If you're not cash flowing from day one, why? If you're hoping and betting on rental appreciation, well, in the last 5 months, Phoenix is only at a 0.1% appreciation in rent. And I believe that rents are going to come down because we just in the last 3 weeks, we've had double the amount of rentals come to market. Now, another interesting commentary here is from this guy, and he's talking about big hedge fund investors like BlackRock or Blackstone, I forget what it is. But let's see a short clip on what he has to say right here.
There's a lot of moving parts, when you're renting real estate, and then you had to have your handyman if something broke while tenants are there. And there's a lot of things associated with renting properties out, which is getting to my next point, which is the yield that these investors must make. So a lot of times these properties are basically put into almost like tranches, and they're put into basically they're bundled up and they're put into different funds, and then these funds are either sold or they have other investors invest into these funds like pension funds. So they have to provide a certain yield, and if they're not getting that yield on these properties, then they have to pivot. So just like Zillow, when Zillow, really got caught with their pants down, they had to pivot, and they pivoted, and they had to sell literally thousands of properties. Unfortunately, they sold it to other institutional investors, which kind of sucks for the home buyer, but they just were not making the yields in terms of flipping the properties. Now, when they're renting the properties, they have to make a certain yield. And if they're not making that yield, or that yield starts to compress due to interest rates rising, which we all know interest rates are rising, the Fed is going to continually to increase the Fed rates as well, which is going to increase all the adjustable debt. So that yield is getting smaller and smaller and smaller. And when that happens, I believe that these institutional investors are going to start looking at other ways to create larger yields. And ultimately, I believe that these yields are going to come in the form of less management intensive investment portfolios out there, whether that's treasuries or certain bonds.
So it's interesting to me because we remember in, I think it was 2021, that Zillow stopped buying homes, right? And they had to dump a couple thousand homes on the market and lost to the tune of $5 million. So if appreciation slows down or starts to go in reverse, and rents go in reverse, which I think that we could see real shortly, will these hedge funds start dumping inventory on the market? Now, if they dump a bunch of inventory, like thousands of homes on the market at once, they're going to, cut their own head off as far as value goes. They're going to crash their own values. So I don't really see that happening, but I do understand what this guy was saying, that buying these homes with a pool or without a pool, you got to have a maintenance guy, you got to have property management, and it is cost. There are costs to that, and it is intensive to manage this many homes. So I think we might see more inventory come into the market from those people. I also think we might see more inventory come into the market first by small investors like myself. I'm a small investor, and I didn't see the cash flow, so I dumped our property. So I'm hoping that everyone is able to afford a home in the near future, and I hope prices. I don't wish depreciation on anyone, but these 20% a year is unsustainable, and the affordability has to come into play eventually, because wages are wages. Yeah, I mean, if you can't pay for it, then how are you going to buy it? And that is going to be a huge factor. It always should have been a factor when purchasing a home. I think you're going to have more choices out there. I think that you're going to be able to find a home that you actually love instead of just settling for a home because that's all there was on the market. I know we love our home, with the exception of maybe it being a 2-story and not having an RV garage that holds 10 cars, So I know Cheryl's really looking hard for a 10-car garage home. Anyways, appreciate you guys watching. And if you have any questions about purchasing a home or refinancing, debt consolidation or whatnot, give me a call. Number's down here on the screen, and I'd love to talk to you. Thanks for watching.